so you got a lot of deliveries that came in, but a lot of people are saying, well, God, look at all these deliveries. But some of these are deliveries that are bringing metal onto the market, not taking it off the market.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics as we continue our coverage on the upcoming December COMEX deliveries in gold and silver, which I know there is a lot of interest in with the open interest numbers still looking pretty big, and perhaps they will be record setting. Although at the end of the day, what does that really mean? Will it have an impact? What is really going on? Fortunately, to dig into all that tonight, Bob Coleman of Idaho Armored Vaults is joining us and is going to explain the COMEX, what's going on there. So, Bob, it's a pleasure to have you on the show. Welcome on in. How's everything going with you today?
Good. Thank you, Chris.
Well, it's a pleasure to have you. I know you speak quite a bit about the COMEX, and I guess first, if you have any preview of what you are expecting for December, do you think we'll see record amounts? And if so, what does that really actually mean in the grand scheme of things?
The delivery reports that I think a lot of people focus on, to me, are somewhat meaningless. And I hate to trivialize that, but a lot of it's just book entries. It's just moving metal around, staying within the COMEX system. And I think a lot of people expect these delivery reports to actually mean something more than what they actually are. If you really want to follow the COMEX a little, on a net basis, I think just watching the warehouse and depository stocks, the levels in the registered category and the levels in the eligible category would do more justice, because then it filters out all the noise of, okay, someone's getting stopped out. Well, a lot of times that may just be ETF positions, a person bringing metal onto the market and putting it on receipt, which we saw a lot of basically from April forward. So you got a lot of deliveries that came in, but a lot of people are saying, well, God, look at all these deliveries. But some of these are deliveries that are bringing metal onto the market, not taking it off the market. And in fact, most of the time, it's metal coming onto the market, not leaving the market.
Okay, that makes a lot of sense. And I guess what is it that has changed then? Because we've had a lot of the guests I've had on the show talk about how the EFP market, basically that link between New York and London, the spread blew out March 23rd and 24th. And I think it's around then when we started seeing bigger numbers on the COMEX. What happened there? And again, just as like, what does it actually mean in the grander scheme?
Well, I think what you saw was basically the EFP market. It's that contract actually it's an over-the-counter contract. It's not an exchange regulated enforceable contract. But when that blew out, I think what you saw was liquidity issues that we were seeing in March. Banks that traditionally had used the futures markets to hedge physical product, I think the virus kind of threw everything off kilter, and so banks couldn't get physical product, therefore they had to close out their hedges, and then all of a sudden there was no liquidity to close out the hedges, so the offer price blew out, and that's why you saw the huge spike in the exchange for physical premium. What you saw on the aftermath of that was a lot of refiners then saying to themselves, okay, with COVID coming in, production is diminished. Why not we take our metal and take advantage of the arbitrage, which is what the banks typically always has done. And so what they started to do is start to deliver a ton of metal onto the COMEX. And so you saw from all different directions where metal was coming on, and it could have been central bank metal as well, but metal was coming onto the COMEX and taking advantage of that arbitrage opportunity of, basically rolling contracts, selling the front month contract. But the way they were doing it was they were using their underlying metal as collateral, not necessarily ponying up some money like the bank does, because the bank traditionally uses their own capital and their proprietary trading to take advantage of arbitrage and spreads and things like that. Well, in this instance, the refiners were just taking their metal, putting it onto the COMEX, putting it on receipt and so forth. And there's a process to do that. So there's transparency there where there wasn't the transparency that London had. And I think the COMEX acted as they are as an exchange. It added a little bit more infrastructure to clearing transactions. So people felt more comfortable putting it onto the COMEX rather than doing an over-the-counter transaction in London. So basically, the COMEX became sort of the London market in a way, is the way I kind of look at it. And people were just using their metal as the collateral for taking advantage of the arbitrage.
Yeah, and I've also heard a lot of several folks mention how COMEX was never designed to be a delivery mechanism, but that has kind of happened this year. Yet, have we seen any metal actually leaving the building, or so far is it just shuffling it? Are they even shuffling it across the imaginary line, or where does that stand?
Yeah, and that's a great question. You're correct. The COMEX, by the rule book, because the seller of the contract dictates the terms of the delivery process, the buyer if someone buys a contract, there's no guarantee they're going to take delivery of that contract. But yeah, to your point in terms of the metal and the leverage, because you hear a lot about, the paper market is so much more leveraged than the physical market on the COMEX. And, we obviously saw that in 2016. I mean, you saw 300 ounces of paper gold to 1 ounce of physical gold, in terms of what was backing those registered contracts. Well, to give you an idea how much metal has come onto the market, the beginning of the year, the registered category had about 1 million ounces of metal in inventory in the registered category. That number now, let me see, we're about 17.3 million ounces of metal in the registered category, meaning those are the ounces that back the futures contracts with gold. And to put that into perspective, what that means, in 2016, you were as much as 300 ounces of paper ounces of gold to 1 physical ounce of gold. The leverage ratio has completely collapsed down to 3 ounces of paper gold to 1 ounce of actual physical gold. The COMEX has turned itself into a physical collateral type of an exchange rather than a speculative hedging exchange. There's been a big shift here, and that's the frustrating part that I see with a lot of people saying the COMEX is going to fail. Well, it's the exact opposite. The COMEX metal has been just coming on, out of the woodworks to be put onto the exchange and not leaving the exchange. And that's why these delivery notices don't mean anything, because a lot of that may be metal that's being put onto the exchange or being put on receipt.
Okay.
And to give you an idea also on silver, at the beginning of the year, it was about 80 million ounces in the registered category. Now there's 143 million ounces in the registered category. That registered category is the ounces that back the futures contracts. That ratio now has dropped to 5 ounces of paper to every 1 ounce of physical. So you had a complete collapse in leverage there as well.
So you mentioned sometimes you have the comments of whether there's going to be some sort of fracture or failure on the COMEX. Do you see that happening? Do you see a situation where there's more paper out there than physical metal, and that leaves a hole if enough people decide they want physical metal? Do you see that as a concern?
The only way that I see the COMEX becoming that has any type of concern to it, I should say, is if metal starts to leave that system altogether, meaning metal finds a new home. It doesn't necessarily go back to London, but it doesn't go to a COMEX facility either. It goes to, like, for instance,
right.
we've taken delivery from the COMEX to our facility, but we're not part of the COMEX system. So we don't report what we hold in terms of 1,000-ounce bars, for example, of silver. So if that metal started to leave and come here, for example, or go to another facility that's not that's sort of outside that system, then that metal starts to go down, and the leverage ratios may start to increase. What we've seen, which is interesting, is the open interest, and some of these numbers, how I give you these 3.22 ounces of paper gold to 1 ounce of physical, and 5.59 physical ounces or paper ounces of silver to 1 ounce of physical silver. Basically, these numbers are completely transparent. They're right on the CME website, as well as the CFTC Commitment of Traders reports. So they're reported numbers, which makes it more transparent. Whereas in London, it's not very transparent. And I think that's one of the other advantages that the COMEX has provided players in the industry, so that need that transparency and sort of liquidity, and now obviously collateral, because they're using their metal as to take advantage of that arbitrage.
Yeah, and Bob, I appreciate you mentioned the difference between whether it's the seller or the buyer that takes delivery, and it's the seller issuing the delivery notice. So along those lines, when people wonder, will someone stand for delivery? Let's say somebody did want to take like a Hunt Brothers or Warren Buffett type, take a large position like that. Again, you said what would catch your attention, or when you think there'd be a risk, is if someone starts pulling it out of the system. In that sort of scenario, or let's say that did happen, what would you expect maybe as a warning sign a week or a month before that happens? What would be a tip-off point that something like that might be coming?
Well, I mean, you'd probably be watching open interest. You'd be watching option activity. You may see open interest start to perk up, meaning people are buying more contracts, or somebody's buying more contracts basically to then take delivery against, basically breaking the contract, converting it, and then asking for delivery. I'm sorry, when they break the contract, they're actually, they already own the metal. But if you start to see an increase in activity in terms of the number of contracts, that might be because obviously you have limitations of how much you can actually deliver on a monthly basis. I think it was silver, it was 7,500 contracts. I think it was, or I'm sorry, either 75 or no, I'm sorry, 1,500 contracts. I think you could ask for delivery for on a monthly basis. I don't know if they increased that or not, but there are limitations to it. But that's what you'd want to see is something percolating behind the scenes that is, if someone's going to be taking delivery, they're probably going to be using the options market to potentially hedge their price exposure, because they're trying to actually get the metal, but they don't want to have the market go completely against them to the downside, for example. So they may use options markets to hedge, or they may be buying calls, knowing that if they start pulling a lot of metal off the market, people are going to see it, prices are going to start going up, and they may use that as a way to make even more money, and then potentially turn those calls that they make in more money with, then turn around and start buying potentially puts to hedge the price exposure if the price happened to pop up, for example. But there's different ways that you can trade the markets and use those instruments to either hedge or to take delivery of.
Right. Well, hopefully, should any of those signs start appearing, you'll come back and join us on the show again. A lot of folks who think that, myself included, think that we're headed there in some form, just looking at the conditions of the world and demand. So will be interesting to see what happens. One other thing I wanted to run by you, believe it was in front of the July deliveries for silver, but we saw that switch of 30 million ounces or so on that first delivery notice day for JP Morgan between eligible and registered. perhaps could you explain the difference between eligible and registered and what that means? And then again, specific to that transaction, when they switched that 30 million ounces, what did that in reality actually mean?
Um, I think what you're referring to is when they took 30 million ounces off the eligible category and added it onto the registered category, I believe.
Right.
In that instance, the eligible category is basically, for instance, on silver, it's 1,000-ounce silver bars that meet all the qualifications to become a deliverable bar onto the COMEX against a futures contract. So it's not eligible category doesn't mean it's metal. It's actually directly on receipt with the COMEX to back a futures contract. It's just it's a bar that's eligible to do that. The uh, Putting that metal onto it could have been a number of different things why they took the metal and put it on receipt. It could have just been someone that says, hey, listen, I see an opportunity to take advantage of the arbitrage, and I want to go ahead and take my 30 million ounces, for example, and put it on receipt with the COMEX, then basically use that as collateral in my futures account to then go ahead and start selling maybe the next front month futures contract, or you know, get involved in the options market, selling premiums and things like that. But that's probably what had taken place.
Okay, well, I appreciate that. I know a lot of people have wondered. And last question I have for you today, Bob. In a lot of these interviews, the term the wholesale level or just the wholesale in the gold and silver markets, could you explain what that means, what function and role and function that plays in the markets? I just think that'd be helpful for people who hear that term a lot.
Sure. The way that the industry is structured is you have the refiners, that make the product, for example, or the mints that make the product, and then you have the distributors, which are the wholesalers. Those are the ones that have the direct relationship with those mints or refiners. They tend to be the distributor for those products. But to become a distributor, you have to have a pretty good sized pocketbook. And so from a retail dealer's perspective, for example, as a wholesaler, you have to buy 100,000 silver eagles at a time, or whatever the number may be. You're committed to be buying this on a consistent basis. Whereas the retail dealer, he's servicing the retail client base that may buy a bunch of metal one month and then the market may go very soft or quiet the next month. So he doesn't want to be committed to buying a certain amount of product from a refiner, from a mint. So the wholesalers take that commitment, and then they obviously then their channel after that is to the retail dealers, and then the retail dealers sell to the retail public. That's traditionally how it's operated. The Where things get a little bit murky is a couple of years ago or a few years ago, the wholesalers tried to get or started to get into the retail business by creating a direct retail arm, and yet some of the retail dealers try to get into the wholesale business to provide more flow or volume of activity. And so things got kind of convoluted there because some people tried to play both sides of the coin. And what ended up happening was a lot of retail dealers that relied on a wholesaler. Well, now the wholesaler is competing directly with their own client base by setting up a retail arm. So it poses, and then you started to see a lot of premiums collapse from 2017 to early 2019 or mid 2019. You saw premiums just collapse because it was just so much competition, and obviously there wasn't as much interest in the market because 2017 you had the big digital crypto run, and then the stock market started to take off and the real estate market took off. So you just didn't have the interest in the metals, and until really February of this year, that's when things really started to perk up, and then at that point you had sort of the I guess you could say the uh, uh, perfect storm, because at that point you had the retail environment didn't carry a lot of inventory because they weren't seeing a lot of activity. The wholesalers weren't carrying a lot of inventory. The retail, I'm sorry, the refiners weren't making a lot of product because they weren't selling a lot of product to the wholesalers who weren't selling a lot of product to the retail. So when that whole storm hit, it kind of caught the industry off guard, and all of a sudden you had delays of delivery, you had increases in premiums to try and attract sellers into the market, and uh, uh, until the market kind of equalized. I think the issue that a lot of people run into, and what I've seen, is there are a lot of players in the market that took advantage of the chaos and really marked up product to the retail environment, um, which which is unfortunate, but uh, they were able to make a lot of money in that scenario, and that's where I've been hearing the last several months, stories of how much people have paid for metals, and it gives the industry a bad name. I really want to see the industry do well, because in order to compete with the rest of the financial products out there, I think it's important to have uh, you know the experience that an investor has when buying metals, for example, that they get a great price, and that they get great service, obviously, but they don't get shafted on the price. And I've seen so much of that this last 6 months.
Well, I appreciate everything you shared here today, Bob, because like you mentioned, it's not necessarily the easiest industry to dig through for newcomers, although I think this will be really helpful for people, especially with everything that's going on. So thanks again for everything that you shared here. And perhaps before we wrap up, can you let folks know a little bit about where they can find more about Idaho Armored Vaults, some of the services you offer, and if there's a way they can get questions answered?
Sure. Our website is goldsilvervault.com. Just gold silver vault, all one word.com. That's a great point of starting. There's a lot of information there. Feel free to call me. Our phone number is on there as well, as well as our email address. And I'd be more than happy to provide any type of support or education when it comes to trying to get people a little bit more not only knowledgeable about the industry and the metals itself, but what maybe answer some of those questions of what do I buy, how do I store, what does it mean to bring it. There's so many different programs out there trying to educate people the differences between segregated storage, for example, and allocated storage, and how to understand the storage agreement when you read that, and what it means when you have different clauses in there, and the responsibilities of the program to its clients and so forth. Those are the types of things that I really get involved in. I think it provides a great service for people just so they can understand before they take that step.
Well, I appreciate that. And again, the address is goldsilvervault.com, where you can find the services that Bob Coleman and Idaho Armored Vaults offered. Bob, thanks again. I know there's December cycle coming up, a lot of interest in that. So I think this will be a great hand guide for people to be armed with going into that next cycle, and be a little better informed. So thanks again for joining me, and we'll have to do this again soon.
Sure. Thank you.